As the expansion matures, the Federal Reserve will need to begin to tighten monetary conditions to prevent the development of inflationary pressures. The Federal Reserve has a number of tools that will enable it to firm the stance of policy at the appropriate time. Most importantly, in October 2008, the Congress gave the Federal Reserve statutory authority to pay interest on balances that banks hold at the Federal Reserve banks. By increasing the interest rate on banks' reserves, the Federal Reserve will be able to put significant upward pressure on all short-term interest rates, as banks will not supply short-term funds to the money markets at rates significantly below what they can earn by holding reserves at the Federal Reserve banks. Actual and prospective increases in short-term interest rates will be reflected in turn in higher long-term interest rates and in tighter financial conditions more generally. The Federal Reserve has also been developing a number of additional tools it will be able to use to reduce the large quantity of reserves currently held by the banking system. Reducing the quantity of reserves will lower the net supply of funds to the money markets, which will improve the Federal Reserve's control of financial conditions by leading to a tighter relationship between the interest rate paid on reserves and other short-term interest rates. Notably, to build the capability to drain large quantities of reserves, the Federal Reserve has been working to expand its range of counterparties for reverse repurchase operations beyond the primary dealers and to develop the infrastructure necessary to use agency MBS as collateral in such transactions. In this regard, the Federal Reserve recently announced the criteria that it will be applying in determining the eligibility of money market mutual funds to serve as counterparties in reverse repurchase agreements. As an additional means of draining reserves, the Federal Reserve is also developing plans to offer to depository institutions term deposits, which are roughly analogous to certificates of deposit that the institutions offer to their own customers. A proposal describing a term deposit facility was recently published in the Federal Register, and the Federal Reserve is finalizing a revised proposal in light of the public comments that have been received. After a revised proposal is reviewed by the Board, we expect to be able to conduct test transactions this spring and to have the facility available, if necessary, thereafter.